Hello, everyone, and a very warm welcome to today's major markets update for Friday, April the 19th, 2024. Strength has turned into weakness. The strength is now to the downside. Relentless selling in bear markets, downside surprises, and upside disappoints. And that is clearly what we are seeing. The market keeps on subdividing lower. Let me go over one of these charts to show you how that exactly went in more detail. So this is the hourly chart of the S&P 500. We have our top here, I believe, late March, and we are now in this potential impulse low. Now, I want to draw your attention to the fact that yesterday we bottomed right here in this gray wave 3 target. So originally I had labeled it as a orange wave 3, but I've upgraded the wave count to 1 degree higher to match it with the daily chart. Doesn't really matter. It's potato, potato. Third wave target zone was reached, and we got a bounce into the fourth wave target zone. And then we moved lower, and this was here where you can see the cursor, yesterday's close. And by then, we had already some positive divergence developing, and technically we went lower below this wave 5 of 3. So technically we've done enough, right? So that's what I write here. Although I would have sufficed that yesterday's low was already all of this green wave 3, it was a little bit odd because the third wave reached the target zone, the fourth wave reached the target zone. Now, it doesn't mean that the market has to reach its fifth wave target zone, but most of the time it does. And now we got there, and it's subdivided nicely in 5 waves lower. So again, a bounce should be expected, but it's not necessary. We cannot anticipate the bounce. We can anticipate the bounce, but we won't be able to confirm it until we go above at least today's intraday high here, this bounce high. Okay, that's the minimum requirement. Then I expect this bounce to go back into what was support is now resistance at around 5,040 plus or minus 20. And then we're going to go below 4,950. Potential as low as 4,900. And by then, the market has shaved off soon 10%. And that's a nice haircut. So here you can see this subdividing wave, 1, 2, 3, 4, 5. Remember, now we are in a downside move. So corrective waves, fourth and second waves, and ABC patterns are counted when we see a up hour. All right, well, this is a 65-minute candle to make sure that we have similar length candles for each trading day. If we do 60-minute candles, we get that's like 6.5 candles. With 65, I think we get 7 candles. So of equal length, which is really, really important. So this is a wave count where we have this nested 1, 2, 1, 2, 1, 2 setup in place. 1, 2, 1, 2, 1, 2, 1, 2, 3, 4, 3, 4, 3, 4, 3, 4, 5. And that would only be green 3, another green 4, and another green 5. I can't put it on the chart. I just don't have enough space. And that will likely bring us to 4,600, somewhere around there. So we have now enough waves in place to consider this orange wave 3 complete. As you can see here, from yesterday's intraday high, 1, 2. So then the drop yesterday was 1. The bounce was wave 2, and today's drop was wave 3. The bounce was wave 4, and now wave 5. Okay, I cannot confirm it until we go back above this wave 4 high, because the blue wave 5 can always subdivide, just like we got a subdivision of this orange wave 5. Wave 3. Wait a second, I think I am off by 1 wave degree here, so this should be like this. I all of a sudden realized there, this is 5, and then that should be 3. There we go. And then this should be 4. Okay, there we go. And then this should be 5. There we go. Sorry, I was off by 1 wave degree. And then this should be green as well. So, and then this should be green as well. I apologize. But because there's so many ways to interpret this, and therefore so many waves to content ourselves with, we sometimes oversee one problem. So here we have one wave, and that makes a big difference. So this would then be 4, and then this would be 5. Okay, so this is a nice way to go about it. 1, 2, 1, 2, 1, 2, 1, 2, 3, 4, 3, 4, 3, 4, 5, 4, 3, 4, and 5. Okay, so materially not too much difference in counting this, but it looks pretty good. Okay, I like it. So this is what we're tracking currently. Again, the bounce should then probably hold below what was support and is now resistance. So above this wave 4 will start to indicate that this wave 4 is underway. Now the gray wave 4 is a degree higher than the orange wave 4 and will likely stay below it. Just like this green wave 4 is a degree higher than this gray wave 4, it should also stay below it. So as you can see, right, the fourth wave target zones are lower because we're in this regime of lower lows and lower highs. And then ultimately, I still think this should go to, as I showed you here on the daily chart, somewhere around 4,800 plus minus 50. So as you can see here, 3, 4, 3, 4, 3, 4, 5. Okay, this makes sense. I like it. Looks good. Then a bigger bounce, and then the next leg lower. So we're tracking a potential impulse. Okay, so we don't know yet if we're going to get this impulse complete, yes or no. Okay. Let's have a look at the daily chart. So I wanted to point out that it's not unusual for an ABC correction to show the similar type of strength, in this case weakness, that we're currently seeing. But this is much more akin to what we would see in a third wave of an impulse. Okay? This is extremely weak market. The RSI 5 is at minus 12. So we're extremely oversold, which matches more of a third wave. Okay. It's not entirely unheard of that this is a C wave. Okay. But it's just simply less common. So the odds favor that this will turn into an impulse. But just because the odds are higher doesn't mean it's a guarantee. All right. No matter how high our odds are, even 99%, we can still get it wrong and lose our trades once in a while. But just that's the price of admission. And as long as we recognize our mistakes, just as I did before with, oh, I was off by 1 wave degree, I apologize, I quickly adapted, it happens. So this supports the notion that we are in a third wave and not in a C wave. Okay? We broke below support, and support doesn't mean much in a bear market. Just as resistance doesn't mean much in a bull market. It just grinds through it. And here we see the same. We have been kind of gyrating around this 5,050 level for 3 days. Held it, dropped below it, retested it, and now firmly below it. So the next support here is at around, I would say 49.25-ish, okay? And that matches, of course, really nice. 3, 4, 3, 4, 5, okay? 3, 4, 3, 4, 5. Bigger bounce, bigger drop. We'll see how big this drop will be. I cannot foretell you exactly how much it is. Let's first focus on the completion of this impulse, which is now favored. We're well below resistance, right? This is this curved resistance band. We have 1 touch, 2, 3, 4, 5, 6, 7 touches. So this is a valid line that is currently underway. In the sense that as long as we stay below it, downside should be favored. I shared this chart with you before. There is potential for this larger top to already have been struck. Though, of course, we have similar setup as we had late 2017 going into early 2018, which suggests we're somewhere here, right? And that we get a new all-time high, then another crash, if this analogy, of course, holds up. What's more important is that this analogy foretold of a larger pending correction, which we're seeing currently. This is the bullish alternative that we're going to about this 4,600 level for this black wave 4. Then a last black wave 5 to potentially, let's say 5,600, 6,000, whatever it is, and then we crash. So here we are already in the super cycle 4, and here we just have 1, 4, 5 left. We'll go to super cycle 4. Again, The monthly RSIs look nauseatingly diverged. The monthly MACD does not look happy. The monthly money flow does not look happy. Look how much money flow is, we're currently at 71, and where we were here in late 2017. That was almost 100. Liquidity drives markets. So we're moving higher and higher with less and less liquidity. No real surprise, as a lot of this market has been driven by quantitative easing. Extra money has been printed, and that, of course, has been taken out of the market as there's no more quantitative easing. Some quantitative tightening is going on as the Fed is rolling off its obligations. This is the Nasdaq. Closing prices, we've completed this nice ending diagonal, and we should now be on our way to the beginning of this diagonal, and that often happens in rapid fashion, which we're currently experiencing. So as you can see here, this is somewhere at the beginning of this diagonal, and we're getting awfully close. So again, this is 5 waves lower, so this still looks like a first wave, preferably. There, let's make it something like this, 1A. And then we had our 3-wave bounce, 1B, and we should now be, of course, in 3C. Extremely strong downside strength, which is also translated as weakness. And then we'll see if we're going to get an impulse, right? We don't know yet if we're going to get a 4 and if we will see a 5. We don't know that just yet. Okay, but again, this weakness suggests an impulse, just as we had, for example, here. Okay, this is kind of what we're looking for. And then, of course, we're looking for this positive divergence to develop. Similarly here, positive divergence to develop. This was also an impulse lower, but that was a C wave. And we haven't started even the C wave yet. This is still part of a wave. A waves can be 5 waves or 3 waves, so we don't know it just yet. Again, odds favor this is an impulse lower, and this then might be the completion of this bull market as a top here in March. Now, this is the Nasdaq 100. It does favor question mark 4, question mark 5. I do want to point out the 4-5 is pretty much based on how we interpret the price action here. I'm sorry, this is maybe a little bit too much to look at, but let us zoom in maybe a little bit more if we can. So there we go. If we can do it like this. There, this price action. Is this a 1-2 or is this bottom here, which is a lower closing price in 2022 versus here? This is 1-2 or AB, right? This is still part of a larger correction. 1, 2, 3, 4, 5. So with this lower low, we could interpret this rally since late 2022 was complete. We have completed an impulse. So it all hinges on how do we interpret this price action, the November-December 2022 price action. How do we interpret it? Is it a 1-2? Then we have a 3, 4, and 5 left, or not? I'm not 100% certain about it. So that's why we have question mark 4 and question mark 5 later on. We know, of course, below which price levels we'll never see that 5th wave, but we're not there yet. That is, of course, the October low from last year. We're not there yet. All right, first serious warning is, of course, below somewhere around 14,200, somewhere around there. So please remember, interpretation what we're currently in is dependent on the interpretation of where we have been. How do we interpret this? That is the question, and I cannot answer with certainty. What I do know is that we're looking for a similar setup as we saw. Let me see if I can find it for you again. There we go. As we saw here, this was a clear impulse low. Okay, so 1, 2, 3, 4, 5. So we're looking for that to materialize. Back to the Nasdaq 100 has, of course, the same problem with how do we interpret the November-December 2022 price action. So we still have question mark 4 and 5. We've now reached the initial downside target zone and breached below it. So this is based on 161.8% extension. Market completely ignored it. So we have to adjust it. We have, though, reached already this 17,200 based on simple symmetry. Right? That's just the width of the triangle added to where we broke down from. So we've reached it now. This means that the wave C3 is extending and this wave 4 needs to be adjusted. We still get a wave 4. I'm pretty certain about it. Or at least a bigger bounce. And then still a wave 5. So how are we going to interpret this price action? This might be now, this might be 1, okay? This might be 2, 3, 4. Then we'll get wave 5. And once we start extending, it's a little harder to know exactly where things will top and bottom, because we don't know which wave extensions the market is going to take. Then we'll get probably a bounce back here to what was once support is now resistance. And then we're going to go lower once again. So the overall pattern remains the same. It's that we're dealing now with a wave extension. Wave extensions are known to happen, but we don't know if it will happen, right? That's the difference. It's a known unknown. We know it can happen. Will it happen, yes or no? In this case, it has happened. So we can now lower, of course, our warning levels accordingly. And as long as we stay below those, and I'm going to even lower these highest warning levels for the bears. I'm going to lower those as well. That's how serious the market currently is. So I still overall believe the same pattern is developing. Again, this looks more like a third of a third wave and not like a C wave. Bigger picture-wise for the NASDAQ 100, false breakout, entirely rejected at this long-term trend line. Okay, so that's not a good sign. And again, we're completing 1, 2, 3, 4, a primary 5 wave to complete a cycle 3 wave. So we could go all the way back here to the 2022 lows. We could go all the way back here to the 2020 lows, all the way back here to the 2018 lows. Who knows? That I don't know yet. We have, of course, trendline support here and trendline support there. To be determined. Again, you can see here, how do we interpret this price action? 1, 2, 3, 4. I would prefer it, honestly, to fill in that way. Doesn't have to be that way. But that's the preferred price action. That's why we classify it as question mark 4, question mark 5. Moving on to the Dow Jones. This wave count starts to look a little bit better, in my humble opinion, where we have the 1, 2, 3, 4, potentially 5. Okay, alternatively, of course, we have this wave count going on. And then we already completed, and as you can see, of course, the Dow is already slightly different than the S&P 500, which is more tech heavy, and of course, the NASDAQ and the NASDAQ 100, which are, of course, entirely tech. Well, NASDAQ also contains other issues. And now we'll see. Okay, so again, as you can see, unable to even break above the first warning level. So we'll see if we're going to get 5 waves lower or not. Then this week's low was 3, and this is 4. So a little bit in between either this wave count is fine with me as well, the extended wave 5, 1, 2, 3, 4, 5, or not. Let me lower these warning levels as well. So that's that one. And then, of course, we have that one, that one. And I'm going to lower the warning level on this here as well. I'm going to probably put it as low as there. Now we're going to get this B2 to be determined, a little less certain about it. Semiconductors. Wow, look at this one. As long as the video is not liked by the market, this puppy will go lower. This black line here is pretty much the do or die line for the bulls. Okay. 3 topped, A1, B2, 1, 2, 1, 2, 1, 2. Alternative means we're going to see a lot more subdivisions lower. The gray one means we're going to see only maybe 2 or 3 subdivisions lower. I can't determine just yet which it is. But this is weak. This does not look like the bottom is already in place. Not at all. We're in this target zone, so target zone has been achieved. but I see no bottom being in place whatsoever. I prefer to see bounces and then continue downside. At a minimum, we want to see some sort of positive divergence develop, and I don't see it at all. At a minimum, we want to see price move back inside the Bollinger Bands. I don't see it at all, not yet. It's not there yet. So for now, this still looks bearish. Yes, I would like to see a final fifth wave, as this does look like a 1, 2, 3, 4, 5. The beggars can't be choosers. So overlap here with that 3,900 level. Somewhere, as you see there, that level will really make me reconsider the idea if we will see this red wave 5. So never ever count on anything until proven otherwise, right? So now we are seriously reconsidering if we will see that wave 5. Not seriously reconsidering, it's still possible, but we're getting awfully close. So the bulls are put on watch. Similarly with the IWM, we're tracking this potential impulse. It's still a potential impulse because it hasn't been fully confirmed yet. 1, 2, 1, 2, 1, 2, 3, 4, 3, 4. And so far it continues to behave as an impulse. And then here, 3, 4, 5. Question mark 4 and 5. We don't know it just yet. If we get an impulse lower, I have pretty much no other option than to say that this B wave has topped and we're just at the starting gates of this wave C. Then what we've seen so far is only a first wave. A bounce will be a second wave, and then we'll get the third wave, fourth and the fifth, of only even a higher degree first wave, or A wave. And then we get a bigger bounce for a higher degree B/2 wave, and an even bigger crash for a higher degree C/3 wave. So this is just, if you think this is scary, this is just an initiation of what might happen. Getting very close already to this blue target zone, which is right around support, which is where 200-day moving averages. So it's quite logical for the index, or in this case, the ETF, to find that support, bounce off it, and then eventually drop lower. Looks really ugly. I see no signs of a bottom in place. At the minimum, of course, we want to see some sort of positive divergence develop. So we can lower, again, these warning levels. Okay. For the bears, and I'm going to lower even the final warning level. I'm going to lower it to about there. That means we're pretty serious about the market, that we expect further downside. Again, it is behaving still as a regular impulse. And this is the ramifications for that. Okay, this is how low it can go once this really big C wave gets underway. We're just kind of like this here, all right? We're still months away from it to develop. This one was disappointing. Normally, when there are 2 to 3 consecutive down days that are below the Bollinger Band and below -40, we'll likely see a big update on the 3rd or the 4th day. Well, we haven't had it yet. The only thing we got was pretty much the NIMO moving back inside the Bollinger Band. Fix didn't really work either, and the Bollinger Band setup for the S&P 500 has still not triggered. So this was disappointing. It's about a 90% guarantee. It works most of the time. Again, shows you, even if the odds are in your favor, it doesn't really work. And all we got was yesterday intraday bounce. And that was disappointing, but this also tells us, again, this is weakness. If we don't see this follow through at such ridiculously low levels, it's a warning sign that worse things are most likely developing. If we are in a strong bull market, such kind of downside days, you'd expect it to really be followed then by a large update, because buying pressure in the end in the bull market overrides the selling pressure. And that's what we're currently not seeing. We see more selling pressure, continued downside. So how we're doing on the McClellan oscillator for the S&P 500? Well, it is improving, so that's good. So we're going to start to look for this positive divergence to develop, lower prices with increased market breadth. So under the hood, more stocks are already recovering or not participating to the downside anymore. Right, we're now at -68, and that is up 30 points from before. But again, positive divergence can take a while before it finally kicks in. Okay, it can take a while. But it's a good first sign of a larger bounce to develop, and that this downside is slowing down for the indexes. Still negative though, right? So the bears are still fully in charge. It's still minus 70. So still more stocks are declining than advancing. And as such, the summation index is still on a full-blown sell signal. It gave a sell signal already here early April. So once again, it worked really well. You didn't get to enjoy much upside here in half of January through the latter part of February. Then we got to enjoy some upside here. Okay, see this from here to there. And now you're out if you use this indicator. It works really well. Again, doesn't work all the time. Here, if you were short, for example, right, you got your face ripped off. But this was a sell signal, and it works, and it works. So again, nothing works all the time. It's just the way it goes in markets. And if we content ourselves with that, the trading will get much, much easier. The MACD doesn't work all the time. The full stochastic doesn't work all the time. AI-based trading system, mechanical-based trading systems, nothing works all the time. You will always be losing trades and always be times that things just don't work out. So the reason, sorry for the rant, but the reason why most people give up on trading is because they think of a market being linear and singular. That somehow there's only one invisible hand manipulating the market, be it institutions with their artificially intelligently driven supercomputers, or be it the Federal Reserve with its interest rates and quantitative tightening, be it they or them, whatever it might be, the powers that be behind the scenes manipulating the market. Those are all excuses. It's of course nonsense. But even the large institutions that drive markets much more than us individual investors are still made up of humans that have the same emotions as us. Most of us are individual traders. In the end, it is a market of stocks, but also a market of market participants. Millions of people are participating in the market at any given moment in time. There is not one singular entity that drives the markets. It's not. It's of course naive and delusional to think. So as such, the market is not linear. It is definitely non-linear. It is definitely stochastic. Stochastic meaning there's a multitude of parameters, which means it's complex. All right. Complex means it is made up of complicated parts, which are made up of simple parts. It's like a car. Okay, a car is complicated, but the individual parts of a car are not so complicated. The screws, the nuts, and the bolts, the sheet metal, all by themselves are quite simple. But put the car into traffic, it gets awfully complicated. That's where the human factor comes in. So markets are extremely complicated and definitely not singular. So if you think that, you will not make it in the market. You have to think of it as a multifaceted, dynamic animal that keeps on changing. So that's why also the Elliott wave tends to change over time, and why we have a preferred and alternative count. Moving on, the PMO buy all sell all remains in a sell in the ideal bottom region, but zero buy signals. How we're doing on seasonality? Well, so far so good. But seasonality forecast is the top somewhere early April. I think we got to top late March somewhere here. So it's pretty good. And then it should see a decline into around Friday, Monday. We should see a rally into later next week, and then a drop all the way into May. And then from there, we start to rally once again. Again, it's about the direction, not the magnitude. Okay, this is just not means we're going to go to new all-time highs, this 105%. It's all about the magnitude. Okay, that's simply the direction of the trend. So again, I'm anticipating a low reasonably soon. I'm anticipating a bounce, a multi-day bounce in that sense, not just intraday, couple of hours, reasonably soon, and then lower once again. So far, so good. It's reasonably well on track. How are other people looking at this market? Well, this is work, of course, by Avi Gilbert, who we track. This was posted, I think, today, from 3 days ago. Also, he is warning that is the topic place. Okay, he has been ringing the alarm bell as well. He also was like, we can still expect upside as long as we hold above these key levels. The first one for Avi, I believe, was 5,091, and then 5,056, and then 49.46. Well, we've broken pretty much below all of them, and they're tracking a impulse lower. And they also have they're warning you time to be cautious, right? It says time to be cautious, and that we're starting to look here for a much bigger correction and a much bigger bear market. Okay, and he's been around long enough, a lot more followers and paying subscribers than I do. That doesn't mean he's necessarily better than my work, but when great minds think alike, heed their warnings, so to say. And if we're wrong, it's fine. You can always catch the next train, right? That's the whole point. It's okay to be wrong in this case. Even from an IWM, we're in the same boat that this looks pretty toppy. So, it pays to shop around, see what other great analysts are looking at. Just because the market has been up over the last 100 years on every Wednesday doesn't mean it will go up next Wednesday too. Those type of studies, I think, have the least power. That is simply assuming that the current market is exactly the same as the one we've had over 100 years. And one of the comments that I received for my article on investing.com was like, it would be absurd that this 100-year bull market is over. Well, after 100 years, don't you think it's maybe time to consider that it might be over? The longer it takes, the more likely it is that it is over, right? So it's kind of, it's a counter argument by itself. It's countering its own argument. So people still, I think, are not ready yet for this market to have topped. And if this market has topped and heading further down the road at lower and lower prices, at some point, I think a lot of people have much bigger fish to fry than some of the current issues that we see floating around in the news. Once things go really south, and again, if this is indeed the case that we have put in a major super cycle 3-up, we're just getting warmed up. This is just a cracking of the knuckles. Let's get ready. We haven't even done a first punch yet. We're not even close. So again, if you have trouble with trading or want some help with trading, please sign up for my ETF trading alerts. These are all our trades. I must admit the short term for the NASDAQ 100 hasn't been the best. Intermediate term, we just got stopped out here for a 18% gain. We've been long since November last year. That's nice. And this, of course, excludes dividends. We've been stopped out on our long-term 2-time ETF, also from November last year for a 13% gain. Easy peasy lemon squeezy. You don't have to worry about a thing. You just buy when it says it buys and you sell when it says it sells. You don't have to think about anything, just execute. And the short term for the S&P 500 has no reason. Well, yes, see, there will be losing trades. Some are bigger than others, but please remember, we don't always enter full-sized positions. So our current position is up 6%. It's about 0.5%. So let's say you normally trade 10 or 25,000 or whatever your amount is as a full position. This is 50%, so you only add 5,000 or 12,500 into your trade. So, right? So we also take appropriate risk in position sizing. We'll take positions off the table, in this case, when things start to get quite overcooked, right? Then the risk increases, that at some point the trend will bend and move lower for the inverse ETF. So currently inverse ETF. So the last 3 trades have been nice winners, 1.4%, 1.9%, 6%. The previous one was a loss, minus 3.6. We had here a loss, minus 5%, but that was only 0.25% of a full position. So for one's overall portfolio, it wouldn't hurt too much because, it's only 25% of a full position. And in my humble opinion, a full position should not even be more than 10% of your entire portfolio. So in this case, your entire portfolio, if it's 25%, is only down 1.2%, something like that. Again, the short term for the NASDAQ 100 hasn't worked too well this year. It's been quite choppy lately. January was okay, but then February and March has been quite choppy in the technology sector. It happens, but overall, I'm pretty pleased. Long term, look, we're still long from March last year. And these signals won't trigger until the end of the month. If we get stopped out in between, won't be updated. But also here, of course, these numbers are now a little bit less for the QQQ, right? That one is, of course, nicely long still. Excludes dividends in the gains. So you get dividends, you can reinvest them, you can do whatever you want with it. It's all good. So this is a great way to help you in your trading. Now, last but not least, this is a very interesting tweet I saw. It is my pet peeve that the government is essentially lying to us on any aspect you can think of. As soon as somebody in the government opens their mouth, federal government, it's a lie. It's getting so blatantly obvious, it's nauseating, it's very sad. But this here is, let's see, initial filings for unemployment insurance, okay? Over the last 5 up to 6 weeks, we have the exact same numbers. This is from the Federal Reserve themselves. As you can see here, it is all 212,000. 212, it's all the same, okay? That's weird. So this was pointed out by Tom McClellan, who I highly regard. So this is weekly jobless claims from the Federal Reserve themselves. And this is over the last pretty much 2-3 months. It's all the same numbers. And then not even that, you can see. This is statistically impossible. Just as we had the jobs numbers before, it was a 5 sigma event, 1 in 6 million chance that we got such a blowout number. So that meaning that the number was so much different from the predictions, it is statistically impossible. And to have then these blowout numbers subsequently is even more statistically impossible. So that's just a blatant lie, and then say, well, you know, we have different methods that yada yada. Most of the time, the simplest explanation is the best, and in my humble opinion, it is blatant data manipulation. Once again, somebody's sleeping at the wheel, or they're just doing copy paste. Again, so please be careful when we interpret this type of data that comes out. Be very critical. If we are indeed in a super cycle 4, there are some very large powers going around during these cycles that have a vested interest in spinning a certain point of view. So please always be very critical. I think that's my bottom line. Very critical of all data that comes out of our beloved government. I'm not an anarchist or anyway, but I think after COVID, we have to realize things are not as good as they seem. And my own opinion, government doesn't always have the best interest. If they have our best interest, then why this? This is statistically impossible. This is impossible. Okay, we cannot have this type of numbers. It's never. Anyway, sorry about that long rant. Bottom line is, of course, we're tracking a potential impulse slope. It has not been confirmed. The market looks weak, and I have 0 signs of a bottom in place. We continue with a pattern of lower lows and lower highs. The Dow Jones counts a little bit different than the tech-heavy indexes, but otherwise the IWM still looks like it wants to develop an impulse lower. Currently very oversold. Please note that the market has not responded to a normal pretty high odds trigger based on the NIMO, on where it's been closing. Internally, things are improving, but the market has not responded to it yet. Seasonality-wise, suggests we should see a low around today, tomorrow, then a bounce, and then lower once again, which matches with our wave counts as well. And once we get an impulse lower, it increases the odds once again that we've put in our super cycle 3 top. Cannot be 100% certain just yet. With that, take care, trade safe. I'll catch you all next week.